Welcome to Investing Insights. I'm your host, Ivana Hampton. It might be tempting to buy dividend stocks with the highest yields, but not all dividend payers are safe. Those big payouts could be signaling that a company's fundamentals are cracking. Looming financial risk could wreak havoc on income-focused investors' portfolios, but there are ways to spot dividend traps. Morningstar Indexes strategist and columnist Dan Lefkovitz explains how to avoid the risk. Good to see you, Dan.
Always good to be with you, Ivana.
Well, what is a dividend trap and under what conditions do they tend to develop?
Yeah, a dividend trap is a stock that lures investors in with a big fat payout that ends up being unsustainable. So the dividend gets cut. And it's not just a loss of income when a company eliminates, reduces, suspends its dividend payment. It's usually also accompanied by a share price decline as well. So just a bad investor experience. In terms of conditions, one way for a stock to have a high yield is for its share price to be depressed. That often happens when there are fundamental problems that are challenging the business. So investors have to be really careful. If you target the highest yields in the stock market, that can often lead you to troubled sectors, troubled industries, troubled companies.
You and your team published research on dividend traps just before Dow Chemical cut their dividend in half over the summer. How does your research explain what happened with Dow?
Yeah, Dow Chemical, really well-known business, at times, considered a blue chip stock. But the business has seen better days. Our stock analyst noted that in 2024, the company's dividend payments exceeded its free cash flows. So, at one point, the yield surpassed 10%. So it probably ended up on the radar of a lot of equity income investors. But earlier this year, when the tariff announcements came out, tariffs stand to hit the company pretty hard. Dow announced that it was going to cut its dividend in half, but the warning signs were there.
Other well-known brands have also slashed their dividend payouts since 2020. The list includes Shell, Walgreens, and Intel. What red flags or warning signs were these companies flashing before their cuts?
Yeah, well, one thing I want to say at the outset is that some of these businesses had very long track records of dividend payments and dividend growth. Shell is a really interesting example. It cut its dividend in 2020 at the outset of the pandemic. The oil price collapsed and Shell came under a lot of pressure. It had a track record of dividend payments going back to World War II. So investors that just look at a company's track record of dividend growth or dividend payments, that only tells you so much about the future. In terms of red flags and warning signs, to take Walgreens for an example, Walgreens is a business that has faced a lot of pressures and challenges for a number of years. A lot of us are customers of Walgreens. We know that retail is a really competitive, cutthroat business. On the pharmacy side, Walgreens faced a challenge going back a number of years related to reimbursements from the pharmacy benefit managers that it really struggled to come back from. It was involved in some M&A, global M&A that didn't really add value. So Walgreens was another one. Share price was under pressure. Its yield rose, and it ended up having to cut its dividend. And earlier this year, it was taken out by private equity.
You have written about how income-focused investors can avoid dividend traps. Let's start with step number one on how to spot them. What is the payout ratio and what does it tell us about a company's health?
Yeah, so we publish this research every year, actually, looking at some of the screens that we use in Morningstar Dividend Indexes to identify potential dividend traps and screen them out of our indexes. And I worked with a colleague named Samya Gatani on this research, and she found that the payout ratio, which, as you mentioned, is a great predictor of dividend durability going forward. So the payout ratio is essentially the percentage of a company's earnings that it pays out in dividends. Companies with really high payout ratios aren't able to sustain their dividends. It's kind of, you want this happy medium, sweet spot where the company is being generous with how much cash it's returning to shareholders in the form of dividends, but not to an unsustainable level. You want there to be a cushion. So for an example, Walgreens at one point had a payout ratio of over 300%. Okay. Obviously unsustainable, but a payout ratio, 50, 60, 70% is more sustainable, and payout ratios are a predictor of dividend durability.
Wow. Now, the second step focuses on a company's competitive advantage, their durable competitive advantage or economic moat.
Mm-hmm.
Can you describe what that reveals to us?
Yeah, so companies with moats around their business are more likely to sustain their dividend payments. Morningstar equity analysts assign moat ratings to companies based on, as you say, durable competitive advantage. Essentially, the moat protects a company's profits, and profits fund dividends. So we found that companies with moats sustain their dividends more than companies with no moats.
And your team weeds out dividend payers using a third step that relies on a distance to default.
Yeah.
How does that work? And what did you all find out?
Yeah, companies with better scores on this distance to default metric, which is a quantitative measure of financial health, tend to sustain their dividends better as well. It's a really interesting measure. It looks at assets and liabilities. It also incorporates market-driven signals. So it looks at a company's equity value, equity price volatility, on the theory that the market can often sniff out financial distress before it shows up in the balance sheet financial statements.
How can investors protect their dividend income from risk? And would portfolio diversification help?
Yeah, absolutely. So, putting your eggs in multiple dividend payer baskets is a good way to mitigate against the risk of any one company cutting its dividend, and being selective, applying these forward-looking screens that are predictive of dividend durability.
So, what's the big takeaway if we want to spot these dividend traps right away?
Yeah. So I'll give you some do's and don'ts, three on each side. I'll start with the don'ts. So don't chase yield without regard to dividend durability. Two, I'd say don't get too hung up on track record or company's dividend history. And three, don't worry too much about macro factors like interest rates. I think they're an overrated variable when it comes to the performance of dividend paying stocks. Think about a company's ability to sustain its dividend going forward. Do apply forward-looking screens like the kinds that we've discussed today, and do diversify.
Dan, thank you for coming to the table and providing us with 3 do's and 3 don'ts.
Thanks, Ivana.
We're back with our new Markets Brief segment. Dan Kemp is the Chief Research and Investment Officer at Morningstar Investment Management Europe. He also writes the weekly Markets Brief column on Morningstar.com. Dan joined me in our Chicago studio last week to share his market insights. Now, he's back in London to discuss what caught his attention this week and what he's tracking for next week. Thanks for being here where you are, Dan.
It is great to be with you, and I'm sad not to be there in the studio with you, but it's always rather nice to be here in London.
Oh, for sure. So we discussed on last week's Investing Insights that you would focus on the market moves following the Fed's quarter-point cut. How have the U.S. dollar and bond prices reacted?
Well, that was really the question of the week. You're absolutely right. And my word, isn't it nice to have a predictable Fed? They did exactly what everyone expected, both in the quarter-point interest rate cut, but also in their guidance for the rest of the year. And really, it seemed like the whole market breathed a huge sigh of relief. And so what that meant was that the dollar didn't move very much, bond prices didn't move very much, and although equity prices, stock prices were up about 1.3%, at the end of the week, that was primarily driven by what was happening to individual companies in the sort of technology-related areas, so communication services and technology sector itself. That's what was really driving the markets last week. So it was all calm, which is exactly what we wanted to be, so that investors can focus on the long term and what's happening at individual companies rather than worrying about announcements from central banks.
In this week's Markets Brief column, you zoomed in on the lagging performance of healthcare and consumer defensive stocks. What's important for investors to know?
I find these two sectors absolutely fascinating because they tend to be lumped together when investors are looking for lower risk parts of the portfolio, lower risk exposure. They tend to be less exposed to what's happening in the economy or geopolitics or big moves in the market. And so these tend to be the safe havens that investors look for. But actually, they're very, very different. They have very different drivers. And so it's really important that investors understand what they're buying. And so when we look at these two sectors, both have really underperformed the broader market this year. Low single-digit returns so far compared to a market that's up over 14%, but they've produced that performance for very different reasons. So consumer defensives have been coming off the back of quite high valuations. People are quite enthusiastic about those stocks, and gradually those high valuations have been whittled away, but they still look expensive on average to our analysts that cover them. Whereas on the other hand, healthcare stocks look cheap, according to our analysts. And that's because they face so many headwinds this year, so many concerns from people about the politics and earnings growth and individual company issues. And so what that means is that they're likely to perform very differently if we do get a broader sell-off in the market. And that's why it's so important to understand not only what you own in portfolios, but why you own it as well. You can take two sectors which are typically lumped together and actually are likely to behave very differently. And that's why I thought it'd be a good target to dive into this week.
That is a good reminder. New data on inflation from the Fed's preferred tracker is set to come out Friday, September 26th. And everyone listening and watching, we are recording this on Wednesday, September 24th. Inflation is hovering above the Fed's 2% target still. Dan, what are the market's expectations and what would a surprise in the data mean for the near future?
Ivana, that's absolutely right, that people are expecting the new data to show inflation up about 2.7% versus 2.6% last month. But when we strip away food and energy prices, which are naturally more volatile, they're all over the place, then actually it's even higher. We're expecting 2.9% this month, which is steady on last month. Now, that's known, that's expected. So the big moves are likely to happen if the numbers are significantly different from that. And so if inflation comes in lower, then we can expect a short-term bump in equity prices, probably a bit of a sell-off in the dollar as people try to digest what this means for future interest rates and future policy. And obviously the reverse is also true. So it tends to be the surprises that cause those short-term moves. But let's remember that actually those surprises don't drive returns over the long term. What really drives returns for investors is the earnings growth of the companies that we own and the price that we pay for those earnings and the way that we arrange our portfolio so that it's not overly exposed to a particular risk. So when I see these announcements, I'm always thinking about them as potentials for mistakes, potentials for overreaction, potential for unnecessary extrapolation, and so really danger points for clients. So as we go into Friday, remember that it's easy to make mistakes when we get surprising data.
Well, Dan, thank you for your time today. And everyone listening and watching, be sure to read Dan Kemp's Market Brief column on Morningstar.com on Monday. That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts. Help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.